Good evening, everyone. I'm CA Mansi Mishra, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by CLEAC of ICI. It is my pleasure to be a moderator in the webinar on opportunities of CAs in FEMA and overview of FEMA on 19th of March 2026 from 5 p.m. to 7 p.m. being organized by Commercial Laws and Economic Advisory Committee of ICI. In a short while, we will start this webinar. I would like to apprise you about CLEAC. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social value while combining analytical foresight with commercial acumen. One of the core areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, etc., and to create awareness for professional opportunities for chartered accountants in commercial laws, economic advisory committee. Our eminent speaker will talk on opportunities for CAs in FEMA and overview of FEMA in this webinar, and we hope that the same shall be useful to all the members. Now, I would like you to introduce our today's eminent speaker, CA Kusai Goawala sir. CA Kusai Goawala sir is a fellow member of the Institute of Chartered Accountants of India, qualified in 1986, having 37 years of experience. He is a partner of Messrs. GK, DJ and Associates. He was nominated for 3 years on India's Implementation Committee of WIRC of ICI. He was nominated on Research Committee of WIRC of ICI for the year 2020-21. He has conducted numerous lectures on varied topics like tax audit, IFRS, Ind AS, auditing standards, ICDS, company law, GST, FEMA, non-resident taxation, peer review, training programs, etc. in the seminars conducted by ICI, ICSI, and CME. He was a part of the group which authored and reviewed various publications like Guidance Note on Internal Audit of Automobile Industry, given lectures on FEMA certification course and other lectures on FEMA matters. He was also the part of the group which compiled books published by ICI on Office Management Manual for CA in Practice, Procedural Guide for Ease in Incorporation of Company, Procedural Guide for Registration and Modification of Charges, Guidance Note on Audit of Charitable Trust, Guidance Note on Tax Audit and Section 44AB, Implementation Guide on Audit Trail, Peer Review Manual, two publications on FEMA, Obligation for Non-Residents, Inward and Outward Investment. With this, I would like to overview to Sir. Sir, we welcome you on this committee. Over to you, sir.
Thank you, Mansi. Thank you for the kind words. First of all, I would like to thank the Committee on Commercial Laws, Economic Advisory for giving me this opportunity of being of service to this profession, which has given us so much. I would like to particularly thank Sanjay Agarwal ji, the chairman of this committee, Purushottam Lal Khandelwal ji, the vice chairman of this committee, and other officials of this committee, Mayank, Dipshika madam, others who are, actively participating in this particular activity to bring to the members of our institute a very good knowledge bank. And I believe they are doing a lot of knowledge series, particularly this is a 135 number of series, Know Your Law series 135. So many, series have been done just to educate our members, and that is something which is really honorable. And I would like to say a very good evening to all my fellow participants, fellow chartered accountants, and we would like to share today 2 hours of FEMA overview, and as well as what are opportunities for our chartered accountants in practice. We chartered accountants have got standard practice like income tax, audit, then we have got GST, company law, all these are our standard audit practice areas. This FEMA is something which is different, and there are very few chartered accountants who are specializing in FEMA, or they are aware about this FEMA laws. The reason is that they are all, thinking that FEMA is something very difficult, not easy to understand. Well, my perspective is totally different. And probably after 2 hours of this lecture, I will ask the same question, and you can say whether your FEMA knowledge is reasonably good. Let me give you an idea about what is the complexities of FEMA. If we are all experts in income tax, we are all experts in GST, we are all experts in audits and all that. And if you look at the complexities of income tax and GST law, and if you put it on a scale of 0 to 10, and if the complexities of income tax and GST is at the level of 10, this FEMA ranks at around 4 to 5. So it is much more comparatively simpler than what we are already practicing. So I don't see any reason why a person like us, chartered accountant, who is already trained so well by our institute, cannot adapt to these FEMA provisions. It is a very simple law, very clear-cut law. It is more of a compliance framework. Very simple law. I will tell you very simple. Of course, we are going to discuss a lot of things during this 2 hours, but just an overview about FEMA. It is a very simple 49 sections only, 49 sections act. And most of the items are in regulations and rules. For each and everything you want to do, there is a regulation, there is a rule. For example, there was a foreign investment coming into India, there is a separate regulation and a rule. So you go into that regulation and rule, you will get to know how you are going to get the money, what is the procedure you are supposed to follow. It is like a checklist. You do this, do this, do this, do this, and then that's fine. If you comply with that, very simple English, no question of any ambiguity or interpretation matters, or very simple language. You follow that and you will never go wrong. Here, FEMA, one thing very important, there are certain golden rules which we have to follow. Before we go into FEMA, let me explain you the basic golden rules of FEMA. One is, what cannot be done directly should not be done indirectly. Very simple principle. Don't try to do any stunts. Don't try to do anything which is not in what is prescribed in that regulation. Don't try to deviate from the regulation, otherwise you will be in trouble. For example, if you have to travel from one place to another place, there might be so many different routes. FEMA will tell you, okay, you take this route, you have to take that route. You cannot say, I will take a shortcut, I will go from here. No way. You have to go follow exactly to the exactly what the FEMA has told you. So this is how the FEMA works. And if you follow that, then I don't think you will ever go wrong. And I mean, we have been practicing since about 40 years in FEMA. It was earlier FERA. When FERA was much more draconian, we will discuss that also. And after that, FEMA has come in. And FEMA is comparatively much more simpler and easy to understand, easy to interpret, easy to implement, and simple language. Very simple language. That is what we like about FEMA. And all coordinated. Just find out one document and you will know everything about that particular subject. You don't have to hunt in income tax law. If you are practicing, you will need to know the act, you need to know the rules, you need to know the circulars, notifications, judgments. Very few judgments in FEMA. So there is not much of a ambiguity in that. So there are not much of too many judgments to be bothered about. You just follow the regulations and you will never go wrong. It is very simple. Now let's look at our today's agenda, opportunity for practice. That is what we are all looking at. A chartered accountant, all of you are here gathered for understanding in the 2 hours what you will benefit from this seminar. Yes, you will definitely benefit from this seminar by knowing what are the opportunities available for you in practice, because ultimately everybody wants to capitalize or take benefit of this particular 2 hours of your time you are spending on this. You must take home some benefit, and that is what I am going to start with, giving you this benefit. What is an opportunity for practice? And let me share with you one more very interesting point. In normal practice, which you do income tax or GST or audit, whatever is the fees, in FEMA, the fees are generally double or triple. The scale of fees is much higher. The reason is twofold. One is that very few professionals available in the market for who are handling FEMA. That is one point. So there is a supply demand gap. Number one. Number two, the fear of ED. That is one thing which drives up the fees very high, because people think FEMA matlab it is ED and it is complex. So people always don't mind paying a little higher fees in this case. But of course, I will share with you also that there is no fear of ED. I will explain you. I have appeared before ED. I have appeared before RBI. I have appeared before the central government. There has been no need to be of any fear. I will break that fear today. I will share with you what are our experiences with those officials, and you will realize that they are very nice people to deal with, much more polite, very humble, and they will try to help you out if you are in trouble. So it is not that they are always trying to arrest you. No, that is not the case. I have appeared so many times and I have come home very safe. There is no issue on that. So we will discuss in our today's agenda opportunities for practice. Then we will look at the background of overview of FEMA, because just when you want to start a practice, you should know what is FEMA. So today's lecture will not make you expert in FEMA. I'm not going to claim that you will become expert, but at least you will get an overview of the FEMA law. Now, when you will go into details, you will be able to do it much faster. At least you will know it is not Greek and Latin; it is English. That is what the difference. After 2 hours of this lecture, you will have a clear idea about what is FEMA. And then after that, of course, when you look at those books and the regulations, you will be in a better position to implement, and maybe you will be in a position to practice. There are so many certification courses going on by the same committee who is organizing certification courses. You can join one of them and get a full in-depth knowledge about. There are about 13 sessions or something which is being conducted just now. Some 8 and 9 benches going on, which is almost on the completion. 8 batches completed, 9 batches almost on the completion stage. And I'm also of one of the faculties in those certification courses. And we have given an in-depth knowledge of the FEMA in 13 sessions. Everything is covered. Each and every aspect of FEMA is covered. And after that, you will be considered as an expert in FEMA. And then you can practice, you can have your practice in FEMA. So we will also look at various types of FEMA items like foreign direct investment, non-debt rules. What is non-debt means? Equity rules. Equity. Non-debt is nothing but equity. Overseas investment, the client is in India, he wants to make. Now foreign direct investment is other way around. The money is coming into India from a foreign entity trying to invest in an Indian company. Overseas investment is other way around. The Indian entity investing in a overseas company. So both the things we will discuss today as to what we are supposed to do, and then you will realize how simple it is. Compliance issues we will discuss as to how to comply with FEMA laws. Simple. Now, what are the opportunities that we have got? I told you, it is an untapped market potential. There are so few FEMA professionals. You can name it on the finger. It is very, very difficult to find a FEMA expert in the market today. And that's why we are all giving you this training, so that you all also can multiply and become professionals. So very few consultants, I told you that. Huge demand for professionals. There is a huge demand because of this various complexities which is there as far as the transactions are concerned. People at all levels today are involved in FEMA, somewhere or other. Even your small clients might be involved in FEMA. Give you a simple example. I'll give you a simple example. You have a client who is exporting goods to outside India. Money, you have to realize the money within 15 months. There is a delay in receipt, meaning FEMA is involved. You are required to do some procedure. Whether you are aware, you should be aware about what procedure is to be done. Now he's your client. He's exporting. He's not into FEMA, but he's definitely into FEMA because he is required to be complied with the FEMA. So you have to advise him. Now, if you don't advise him, if you don't know FEMA, he will go to somebody else and then he will shift the business to somebody else. So you will lose out. So you want to know something basics about FEMA. Another thing, let me tell you another basics thing. I have given so many lectures in the offline mode also. And when I gave this example, people said, "Oh, we didn't know this. There are so many clients who are not doing this. Oh, why? Let's implement." So this is how things happen. Like for example, you have a client who is into software exports, software development and exports, and they are doing software and supplying bills, raising invoices to their customers after development of supplying software. So it is mandatory, or even ITES. even software developers as well as ITS, it is mandatory for them to be registered with STPI. Now, people don't know. By just sheer lack of knowledge, they don't do this, and then there is a clear violation of FEMA. Tomorrow, the RBI will slap a big notice, and you know what is the penalty in FEMA? 3 times the amount involved. So it is a huge penalty, and then you have to pay up. So these are the things, basic things, small things, but it will imply another small basic things. A person going out of India is considered as a non-resident on the date he departs. He is required to convert all his ordinary savings account, current account, everything into a NRO account or NRE account. If he misses out, he doesn't know. He doesn't know FEMA. You have not advised. I mean, you also don't know, so you have not advised him. Now, penalty. Simple things, basic things. There's a simple letter to be written to the bank. There's nothing great, no forms to be filed. Just simple letter to be sent to the bank that I am from so and so that I become an NRI. Kindly convert my ordinary savings account to NRO account and take an acknowledgement and follow up with the bank that they have done it properly. This is what we are supposed to do. We have not done it, penalty. Because the bank is supposed to report to RBI about all the transactions in NRO account. They have not reported, penalty. So certification of by chartered accountants. Yes. For example, your client now intends to do an overseas investment. Now, when he wants to do an overseas investment, there is one Form FC to be filed. Form FC contains one chartered accountant certificate. There is a Schedule E in that form, which is required to be signed by a statutory auditor. Now, if you are a statutory auditor and you don't know FEMA, how will you certify? Because you are required to certify whether the overseas investment rules have been complied with. You will not know the rules. How will you certify? Problem again. The client will shift to another person because it is only statutory auditor who can certify. No other chartered accountant. So he cannot take a certificate from any other chartered accountant. He will have to come to you as a statutory auditor for certification. There are so many other places where statutory auditor is required to certify. Form APR, which is again one of the form annual performance report, is to be certified by a statutory auditor. Now, if you are a statutory auditor of a company who has done overseas investment, who is required to file APR, you don't know laws. How will you certify? Problem. So you need to know this FEMA, and that is the reason we are doing this course. We are doing this 2 hours of exercise, which will at least give you some insight about what is FEMA and basic things about FEMA. You can always develop. We are all chartered accountants. When I passed my exam, there were no accounting standards. There was no computer. Computer had just come in. We have learned there was no GST. Only we had sales tax. So Companies Act was old. Companies Act, Income Tax Act also. Everything was old. So much of development. So much of new laws. We all have learned. We have developed. So we are ingrained into that learning. We are chartered accountants, so we can develop and learn much faster compared to other faculties. Then there is a fear of unknown. When we don't know something, we are always scared. But oh, there is something, dark house, dark room, you can't go in because there is something there inside. It is a fear. No, FEMA is not a dark house. It is a very clear-cut knowledge bank, and it is very simple. Okay, and the FEMA and ED, the fear of ED. Now let me share with you my experience with ED. Of course, during the course of this 2 hours also, I will discuss certain things about ED. ED, Enforcement Directorate. You hear about a lot of things about bad things about ED in the newspaper, that they have arrested people, they have searched and seized so many things, and every day you get some news. So many people were arrested, and so and so thing has happened. But those cases are very extreme cases. Those are PMLA cases. Whereas you are looking at FEMA. FEMA is a civil law. There is not a prosecution, is not there. There is no prosecution. And I will tell you, I have appeared before ED. It was very, very, simple procedure. You people were quite polite, Polish, and of course, they are quite professionals also. And they have done their homework very well. You need to be very honest with them and straightforward. There is no issue. Once you are honest and straightforward, they will come out and try to help you out. But if you try to fool them, or they try to, go around the bush, something like that, then is a problem. I'll give you one more very interesting thing in ED. They have got technology which you will never imagine. When you have to appear before ED, suppose you want to submit one document, one agreement. You cannot take only a copy. You have to take the original along with you. Now, when you take the original, they will take the original from you for 10 minutes. They will scan it on a machine. They have a machine, and that machine will tell them whether the ink on which, the paper on which it is printed, the ink with which it is printed, what is the age of that. Now, if the document is backdated or some fabricated document, they will immediately come to know, and then the problem starts. Then that the civil thing becomes criminal because you have given a forged document. So if your everything is clean and clear, the documentation, everything is clear, then there is no need to fear. But if yes, something is wrong, then there is always a fear because that some criminal thing has happened. So naturally there will be repercussions. Now, another advice to you when we are going to for the any hearing for ED or RBI or something, take the client along with you. Don't go alone. And you are masters of law. You are not masters on the facts. Facts let the client present. You become the legal consultant, law consultant. You are expert in the law, not in the facts. So this is how you should practice. Even the letters which is submitted, don't do it on your letterhead. Do it on the letterhead of the company, because it's the company which is making representations. No, you are only supporting them. That is how you should practice. Important aspects of client requirement. India is a global village, and each and every stage you will come across FEMA issues, small issues, but it will become big issues. Like for example, somebody has brought in money from outside India for investment. Now money has come from Mr. A, it shares are allotted to Mr. B. It's not allowed, but it has happened. Now you are a statutory auditor. What are you supposed to do? You are supposed to qualify. So this is the problem. Or you're supposed to advise them that you can't do this. You should know the law. That is what basic things, simple things. Now, statutory auditor, no clear. Any violations of FEMA or anything you are supposed to report. Now, if you don't know FEMA, how are you going to report? How are you going to do statutory audit? The basic thing, our basic bread and butter. But still, you cannot do it because you don't know the law. For foreign direct investments, overseas investments, LRS, all this certification is required by chartered accountant. Form APR is required to be certified by us. Form ODI is supposed to be certified by us. Then there is a 15CA, 15CB for the tax forms which are required for any remittance outside India. 15CB is a chartered accountant certificate. So you can certify a CS, a 15CB, but you should know how to certify. What are the things you should check? All these things you should know. You can be an advisory in respect of FEMA compliance. And that means if you know the law, you can advise your client. Suppose client comes to you, I want to do a foreign investment in my company. Okay, fine. This is what you are supposed to do. This is a checklist. You do this, and everything will be fine. I will discuss today in this lecture what you are supposed to do in this case and what you are not supposed to do in this case. FCTRS is a transfer, foreign currency transfers. And that also, if there are any transfer of shares between a resident and non-resident, first of all, who is a non-resident? That you should understand. That is a FEMA. So that you will be able to understand, because and if you make a mistake between a non-resident and resident, a lot of things will go wrong. For example, if you have classified a person who is actually a non-resident as a resident, there will be a big problem, or other way around. If a person is non-resident and you have classified him as a non-resident, again a big problem. So this is what we are supposed to know, basic things. And the law is again very clear. I will explain you the various sections, how it is, how clear it is. Overseas direct investment, lot of certification, lot of implementation is required. We can implement this particular thing in a proper way. And so that there are today in 40 years, we have been implementing various FEMA provisions. There has been no RBI adverse any letter or anything negative letter for a client saying that this was not done correctly. There has been no such thing, because things have been done in a very proper and a systematic way. We have a checklist for each and everything, and we have applied those checklists as how a statutory auditor is doing the checklist. We have a checklist for each and every item in FEMA. You can develop those checklists. Very simple checklists are there. Go to the regulations, and based on the regulations, develop a checklist. Very simple. Valuation of shares. Yes, we are all experts in valuations, and valuation of shares are required at each and every stage. Now, I will give you one very simple example. Now, suppose if the money is coming into the country when under investment, foreign investment, the rule is like this. Okay, you have to get the shares first valued. Suppose the value, now what method will you apply? Because there are so many methods of valuation. There is a NAV method is there. There is a DCF method is there. Discounted cash flow method is there. There are so many different methods applicable. Intrinsic value, the book value and all that. So many values. 11 UA we have got in income tax, 11 UA method. But which method are you going to apply? In the FEMA, the law says very clearly, you have to apply internationally acceptable method. Whichever is internationally acceptable method is there, you have to apply. Now, what is internationally recognized and acceptable method? There are so many methods, but we have to see what is applicable to the particular case of the case. Now, generally, if it is a going concern, we all know, we chartered accountants know that it is a discounted cash flow is the most popular method. There is no other option. If it is a going concern, apply DCF. If it is not a going concern, the company is under liquidation, apply NAV. Very simple, because you cannot apply DCF for a company under liquidation, because there is no going concern. There is no future. What future cash flows will you discount? There is no future. So you can apply NAV. But when it is a company which is a going concern, yes, you have to apply DCF. So you have to value the shares as per the DCF method, give that valuation to the company. They will use this valuation for the purpose of doing the entire transaction. Then there is a representation before the RBI for any compounding matter. Now, what is a compounding? When there is a possibility of some violation, you have contravened the law and you realize yourself, sorry, I have made a mistake. Now, you go with a folded hands to the RBI saying, oh, I have made a mistake, please compound my offense. So now, as I told you, the penalty, if you don't go to the RBI with a folded hands with the on for compounding, and if the RBI or ED notices this, then they will issue notice for penalty. So then penalty is 3 times the amount involved. Whereas if you go with your folded hands and say, look, this I made a mistake. Now, please help me out. Please compound me. Please, condone the delay. At that stage, RBI has got powers to condone it, and the penalty which or the compounding fee which they will be levied, which will be very fraction of what the penalty you would have paid. Penalty is 3 times, whereas compounding may be around 4 to 5% of the amount involved. So you can see the difference from 300% to 4 to 5% we can save. I mean, you can bring it down, and this is because of the representations given by chartered accountant. We have represented in various cases in compounding with the RBI. In one case, there was a serious matter, and that matter was compounded for just 500 rupees. So it is possible. It depends on how you argue, how you present before the authority. Before we go into FEMA, let me share with you the history of this FEMA, how it is FEMA has been evolved. First of all, it was earlier FERA. Before FEMA has started, it was FERA. FERA 1947, in fact, much before 1937, Britishers brought in FERA in India. That was a British law. Then when we got independent, that FERA became 1947 Act, which is our independent India's Act. Then it was much more liberal compared to 1973 FERA Act. FERA 1974 was draconian. I mean, you cannot do anything without RBI or without central government approval. You cannot do anything. Even the smallest of money remittance outside India, you require approvals. You are very, very restricted as far as the transactions in foreign exchange were concerned. I will share with you one incident happened. During FERA times. I'm talking about prior to 99. 99 FEMA has come in. Prior to that, FERA was applicable. During FERA times, there was a raid on one of the very, very sincere and very senior business house in Pune. And the senior person, the senior MD, a very senior person in age, he was arrested just for holding $100 in his pocket. $100. Today, everybody, each of us can have $2,000 in your pocket and nobody is going to touch you, because that is a FEMA law. Okay, so FERA was that draconian. You cannot have a single dollar in your possession. So that was a law at that time. But it was a need of that hour at that time, because India was going through a phase where foreign exchange was very scarce and it needs to be regulated. So naturally, there was a tightest control on the foreign exchange. Whereas subsequently, when FEMA has come in, FEMA has brought in a era of total liberalization. And when FEMA became liberal and allowed people to send money outside, then money started pouring in. Because once you allow somebody to go out, he will easily come in. If you don't allow anything to go out, money will not come in. It is very simple logic, and they realize this. And today I will tell you, we are lucky and we are proud to be of our country, that we are boasting of $675 billion of reserves, whereas in the past we had hardly 100 million or 100 very 1 weeks of our import amount and in our reserves, which was like a country was not enough. Country was having enough reserves to meet its liabilities for oil and etc. payments. So FERA was the main aim was to regulate payments and dealings in foreign exchange as to conserve foreign exchange for a country's development. And 1947 was a less stringent compared to 1973. Over the years, the economic challenges evolved and India was going towards the global village. So in 1973, new act was formulated, but this 73 act was the most, and the ED was given the widest powers to prosecute, and that's where ED got, a bad name, that it is always prosecuting. It is not that way. ED is not, to be considered that way as a draconian person. They are very polished and they are professionals, I would say. Of course, they do their homework very well before. When you go there, they must have done your entire research on your company or your entity, and they will have all the papers in their file. Tough economic situation was there in April 1991. India didn't have the foreign exchange reserves, and we had to raise about 200 million. They had to raise from the outside market. So they had to ship almost 20 tons of gold from RBI to Switzerland to get 200 million. You can imagine, today we are sitting on a reserve of $645 billion. And that time only for getting 200 million, we are talking about $645 billion. Today that time we didn't have 200 million also. So we had to pledge about 20 tons of gold. Later on in July 91, again, we pledged around 47 tons of gold to get 405 million. So this was our condition. So at that stage, naturally, foreign exchange had to be conserved. You cannot just allow anybody to remit money outside India. So 1973 Act was required. And subsequently, government realized that we will need to open up the economy, because India is a global village. Everybody in India wants to move out, or there are a lot of investments coming into India. Why? Why is the investment coming into India? Because India has got that market, so much of population, so much of market. People outside India feel that yes, they can invest in India and earn good amount of profits. For example, if you go to other countries like Japan and USA, the earnings are very pathetic. For example, in Japan, if you want to open a bank account and put money there, you will not get any single interest, any single rupee of interest. You will have to pay, in fact, something to maintain the account with the bank. Now, in India, you get at least 20-25% return on your investments. That is the kind of IRR we have in India. So they feel that it is a huge amount of, even if they get 15% IRR, they're very happy, because they don't get that kind of IRR in other countries. So India, they are look at, and we have seen so much of inflow of foreign investments in India over a period of so many years. We have handled from FEMA, from 2000 onwards till date, so many 10 to 15,000 crores of investments we have seen in India. Just we have handled it, and we have seen that the foreign investor has made lots and lots of money. I have signed 115 CB of 200 crore of profit remitted outside India. So you can see the kind of profits people have made outside, foreign investors have made, and that has made India a very attractive investment country for them to invest in India. And that's that. In 10,000 crores, suppose, for example, I'm just giving example, 10,000 billions of dollars have come into India by way of foreign direct investments. Now that money which comes into India, it is not just 1 billion which comes in, but it gives a ripple effect, and it gives the economy a boost of 10 billion, 10 times the amount involved, because the money is rotating. The money rotates in India, and that money will generate an economic growth of $10 billion. That's $1 billion will give a 10 billion goal impetus. That is what the country needs. And today the employment, the growth of industrial growth, all that is possible only because the FEMA was liberalized and money was allowed to come into India. What are the FEMA rules and regulations? FEMA 99 replaced 1972, regulate and manage. It is not just regulation. FERA was Foreign Exchange Regulation Act, whereas Foreign Exchange Management Act, it is a difference. It is now managing the foreign exchange. It is not regulating. So deals with the transaction between person resident outside India and person resident in India. If two person resident outside India are doing any transaction, FEMA is not involved. Like for example, if there is a person in USA who is maybe an NRI, who is transacting something with a person in Australia, NRI. If FEMA is not at all concerned. You do whatever you want to do outside. The moment you do any transaction with a person resident in India, yes, FEMA comes into picture. Then there are the definition of current and capital transactions. Now, current and capital transactions are not what we understand in accounting language. In capital transaction is what in our accounting language we consider as what is assets. Like for example, if you are importing, suppose if there is a machines, it is considered as a capital asset as far as our accounts are concerned. But as far as FEMA is concerned, when you are importing machine, it is not a capital account transaction, but it is a current account transaction because it's a trade. It is not something which is a capital nature. Capital nature will be shares or loans, all this, or properties. All these are considered as a capital assets. So current accounts are all the transactions of trade, import, exports are considered as a current account transaction. Any remittances made outside India could be current account transactions or on a capital account also. So that distinction is being done by under the law. Then here we have got two routes of any transactions that you want to do. Either it will be under automatic route or it will be under approval route. Now, what is automatic route? Now the regulations will prescribe you have to follow this principle. If you are in a position to follow that exact the way the regulation has been framed, if you are in a position to follow that, it is under automatic route. You don't need any approvals. Go to your AD bank, go with all the documents, the transaction can be put through. You don't need to go to RBI or to the central government or any authority for any approvals. But yes, if you are not in a position to comply with all the conditions I've seen, even one condition is not complied, you cannot apply automatic route. You will have to go to the approval route. You have to go to the RBI or central government, whichever is the authority, which is the approving authority, and they will examine whether that one condition which you are not able to comply, whether it is acceptable to us or no. If it is acceptable to them, they will give you approval. If it is not acceptable to them, they will not give approval. It is all subjective. Then there is no question of any regulations on that. That is their prerogative. It is a policy decision which they will take. So this is the automatic and approval route. Yes, there will be certain prohibited items in the list, in the regulations. Okay, these are the prohibited items. No authority in India will have the powers to give you approval for any prohibited items. Like for example, any foreign investment coming into India cannot be invested in a company which is dealing in TDR or land. Land matlab buying and selling of land. If you are developing a project, it is allowed. But if you are buying and selling of land, or if you are dealing in TDR, or there are other list given lotteries and all those things, if you are doing this kind of business, which is not permissible, gambling and all that, then you are not allowed to bring foreign investment. It is under a prohibited list. Now, if you are in that prohibited list and if you want to bring in foreign investment and you go to any RBI or say central government, you are not going to get any approval. They will reject your approval outright because it is under a prohibited list and Parliament has said no, it is a prohibited list. So no authority can give you approval. Yes, if there are other conditions which you cannot meet, suppose for example valuation is there, suppose the value comes to 100 rupees per share and you want to allot the share, you can allot the share at 100 rupees or higher, but you want to allot the shares at 80 rupees. Now under the automatic, then it cannot go under automatic route because automatic route says 100 or higher. Now you want to allot the shares at 80 rupees because there is some exigency. Because of that, you have to allot the shares at 80 rupees. This is the deal. Now you have to then go to the RBI or central government, whichever is the body which is approving body, and get an approval, specific approval for this transaction. This may take little time. Automatic route doesn't take time. It is immediate. You can do transactions in a jiffy. There is no problem. Then what are the various things which you are supposed to know? The law, as I told you, the act is very simple, 49 sections. Then everything boils down to the regulations, rules, circulars, notification, press notes. But very simple. You will have master directions. You have to look at those master directions. And master directions, they've got a list of everything that is covered latest. In income tax, we don't have such master directions. Now we have here a master direction. Master direction, suppose for example, you want to see something about foreign investment. Now you want to, there is a client who has come to you for an advice. I want to do a foreign investment. Go to the Reserve Bank of India site, download a master direction on foreign investment. Simple. You will get the latest version. You will get few versions. Take the latest version. Read that latest version. It will be around 10 to 15 pages. Read it. Very simple English, simple language. It will tell you do this, do this, do this, do this. Your checklist is ready. And you can tell the client, yes, of course, you will have to do this in order to, for your transaction to go through. And simply you can implement that particular thing to the client by drafting certain letters, whatever is mentioned in the directions. This letter is required, this consent is required, this is required. All that thing you can draft it out and implement the foreign direct investment for your client at a good fee. That is our opportunity as a chartered accountant. This FEMA is monitored by RBI. RBI is the monitoring authority. But the implementation is done by the AD bank. You don't have to go to for each and every transaction to RBI. The AD bank is a delegated legislation. RBI has delegated all its powers to the AD for going through any automatic route. Transactions are to be routed only through AD bank. You don't have to go to the RBI. Only thing, yes, the reporting is there to RBI, which is normal reporting, but you don't have to get an approval from RBI. So AD bank has got the powers to do the transactions. You want to send $1,000 million outside India, you can do it through AD bank. You don't have to go to RBI. But of course, the policing is done by enforcement department, the ED, which we are all scared about, but nothing to be scared about. They are the people who will be watching you as a watchdog. And if you have violated, if you have contravened any law, anything, for example, in regulation, it is so and so, so and so, so and so, it is mentioned you have to do this. You don't do this. There will be a contravention. And once the contravention is done, the ED will come into picture and he will issue a notice. So ED is the policing officer. I will give you a simple example. Now, as I told you, in case of a foreign investment, money which comes into the Indian company, suppose if your valuation of shares is 100 rupees, you have done a value of 10 rupees share is their face value, the value is coming to 100 rupees. The foreign direct investment regulation, the non-debt rules, which is governing this particular regulation, is prescribing that you can allot the shares at 100 rupees or higher. You can do it at 101, 110, 200, no problem. But you cannot do it at 99.99 paise. You cannot do it. The moment you have done it, your entire 99.99 is a violation. It is not just 0.01 which is a violation. So your penalty will be on 3 times the amount on 99.99. You say, oh, it is a simple rounding up. No excuses. Simple. You were supposed to do it at 100 rupees. Why did you do it at 99.99? Simple logic. The very simple funda. Don't try to do anything which is a shortcut or deviation or rounding up, this, that. Don't do all this. You maintained it thoroughly as per the law, as per the regulations, then you will never go wrong. Do it at 101 rupees on a safer side, so that even if it is rounding up, it will come to 100. It will not go to 99.99. So you can be little more on a safer side. Do it on a safer side. That is better. Non-compliances will attract penalty naturally. Any non-compliances which happens will attract penalty. I told you India is lucky. I mean, we are all lucky to be Indian citizens, and we're proud to be Indians. You see the table here. We have got various countries, foreign forex reserves, excluding gold. Now China is top. China has got the highest, $3,113.85 billion, whereas Japan is second, Switzerland is third, and India ranks fourth. It is above even Russia and United States. You can see we are much higher in the hierarchy. We are fourth in the rank. Okay, we are that time. I mean, today we have got $675 billion of reserves in our account. So which are the act which are the to be looked into when we are looking at the framework of FEMA, Foreign Exchange Management Act 99, passed by the Parliament, which is 49 sections only, 49 sections. Then there are regulations, foreign exchange management regulations. Regulations are framed by Reserve Bank of India. Then there are foreign exchange management rules. Rules are framed by central government. What is the difference between regulation and rules? Very simple. Regulations will tell you what you are supposed to do, what you can do and what you cannot do. Very simple. Regulations will tell you that. Rules will tell you how to do it, how you are supposed to do this transaction. Very simple. It is so clearly linked out. Okay. Master direction. Now, what is this master direction? Master directions are basically RBI's, training to the AD bank. They are giving them what you are supposed. See, they have delegated the rule powers to the AD banks, so naturally they have to train them. No, kya karna hai, what you are supposed to do. So master directions give them the training as to you are supposed to implement this law in this manner. Now, therefore, for each and every topic there is a master direction. For foreign investment there is a separate master direction. For overseas investment there is a separate master direction. For export and import there is a separate master direction. So for each and every topic there is a master direction. Now these master directions are issued by the RBI on an annual basis, or as and when the law is changing. FEMA doesn't change so fast, but whenever it changes, master direction is issued, amended. Now you will, if you download the latest master direction, you will get the law which is on the dot, on the topic. Today, latest news, latest law we will get. So you don't have to worry you have missed out any circular or notification like that. The master direction will contain everything. Like in income tax, we don't get this benefit. There is no master direction. CBDT doesn't issue this. CBDT issues only the circulars or notifications. We have to look at the act, we have to look at the rules, we have to look at all the circulars, notifications, the cash flows, all that thing to come to know what is the law in the subject. Here, very simple. Just download the master directions, foreign investments, and you will get the correct law on the subject and very simple English, 15 to 10 to 15 pages, read it, and you will know everything about foreign investment. You don't have to go anywhere else. Okay. Sir, earlier there were circulars. Now it has become master direction. So there is a difference. Notifications, sometimes they issue notifications, and these notifications are covered under master direction. So you will get everything on the notifications that change, modifications to the act, to the regulations, they issue notifications. Circulars are also issued by the RBI, and that circulars are also incorporated in master direction as and when they are amended. Earlier they were issuing press notes, but I now of late I don't see any press notes. Earlier press notes were being issued by the government. That is done by the central government. There are FAQs. Whenever you want to know what are the questions come to your mind, how to deal with it, the RBI has published FAQs. So it's solving your problem. Okay, your exact problem, if it is there, you see the question, and if it answers your question, well, you will know what to do in those situations. There might be something which is not mentioned in the regulations or the master direction. It has come to your mind. What I'm supposed to do during this? FAQs will contain those things. So it is a very good help and a very easy to understand subject. Now, regulation and rules hierarchy. Section 46. 46 is authorizing the central government to make rules. It is under the FEMA Act. As I told you, there are 49 sections. So the 46th section is authorizing central government to make rules. Section 47 is authorizing RBI to make regulations. Section 48, these rules and regulations have to be placed before the parliament. You cannot see earlier in income tax also there was some challenges. A circular issued by CBDT, what is the law, whether it is law, because somebody can challenge, no, it is not binding on the assessee, and it is because it is not placed by the parliament, placed before the parliament. Here they have made it mandatory for all these rules and regulations which are published by either central government or RBI, whoever is applicable. This has to be placed before the parliament and approved by the parliament, so it becomes a law. Now you cannot go and challenge that this is not the law because it has been approved by the parliament. So all these rules and regulations are part of the law. It gets authority equivalent to the law. So regulations are the instrument by which the powers to make substantive law is exercised, and rules are the instrument in which the powers to make law procedure is established. I told you how to do it. And what is to be done is in regulations. Regulations are of wider import, scope much broader than rules. If they are revised, then it contains R. So you know it is the revised one, it is the latest one, and the date and the year comes along with it. So you know which one is the latest one. So you can refer the revised one, which is the latest. Which are some of the foreign exchange regulations? I'm talking about regulation and rules. So which are some of the regulations? Permissible capital account transaction regulation. Now, which are the capital account transaction which are permissible? It is given in this regulation. Borrowing or lending in rupees. What are we supposed to do? What are we supposed to do to borrow money in rupees? Fine, everything is come. What are we supposed to do when you have to lend money in rupees? Everything is there in this regulation. Deposit accounts, bank accounts. I'm going to discuss this bank accounts with you. NRO, NRE accounts, and I'm going to explain you what is the difference between NRO and NRE in such a way that you will never forget for life. We will come to that a little later. Acquisition and transfer of immobile property outside India. Now, this particular regulation has got merged with non-debt rules. So it is now no longer applicable. This regulation has been deleted, and instead of that, it has been merged with another regulation. I will discuss that a little later. Realization and repatriation and surrender of foreign exchange. And how do you get the money from outside India? I told you, if you are exporting, that the money has to come into India within 15 months. This is mentioned in this particular regulation. Possession and retention of foreign currency. I told you, everybody can keep $2,000 in their pocket. It is part of this regulation. This regulation tells you how much you can possess foreign exchange without any problem. Remittance of assets. Allowed to remit money outside India under various schemes. There is the LRS scheme that is called Liberalized Remittance Scheme. We all are residents in India. We can remit $250,000 every financial year per person outside India. No questions asked. Now, what we can do with that $250,000? You can open a bank account outside India. You can buy properties outside India. You can buy shares outside India. You can do all this kind of transactions. $250,000 is almost about 2.5 crores. Today's value is around 95 something. So it is at least about 2.25 crores. You can remit outside India per year per person. Suppose if you have got 3 members in the family, 3 members can remit money outside India and buy property jointly. It is allowed. And this is 250,000 is for resident. A non-resident Indian staying outside India, hand balance in their NRO account, can remit up to $1 million. 1 million is today around at least 9 crore rupees. The dollar is around 90 rupees. So it is 9 crore rupees we can remit outside India per financial year. No questions asked. This non-debt rules is supersession of transfer of equity, I told you, and acquisition of property. Both these regulations have merged with these non-debt rules. Investment in firm or proprietary concern is also allowed now. It is not earlier, it was not allowed. Now they have allowed investments in the firms and proprietary concerns also in India. Of course, there are conditions, there are regulations. You have to apply those regulations. It's not that you can blindly bring the money in. No, you have to comply with those conditions. If you don't comply with the conditions, you can't do anything. Automatic route means you comply with those regulations. Simple. What are the rules which are applicable? Regulations we saw. FEMA is designed to consolidate and modify law pertaining to foreign exchange. 46 permits the rules. According to section 13(3) of the Constitution, rules are considered to have the value in the law, the eyes of law. Now, which are the rules which are today in vogue? Current account transaction rules. Any money which you want to remit outside India on a current account transactions. Now, I will tell you, India is current account convertible. That means if a non-resident Indian is earning rent income in any property in India, any shares is getting dividend, any FDs it is getting interest, although it might be out of local funds, no issues. It is not coming, the money has not come from outside India. So the money has come from outside, it has not come from outside India, it is a local fund, but you are earning income on that. That income can be repatriated, remitted outside India without any limit, no limits. Interest, dividend, rentals, all that can be for a non-resident I'm talking about, not resident. Non-resident earning this income in India can be repatriated outside India without any limit. So this is current account convertible. There are other current account transactions also can be taken. There are, of course, the conditions and limits that you have to apply. If you want to go outside India for some education, there are some conditions. If you want to send something for the medical, but of course, it is very highly liberal. For example, if you are looking at education, whatever the school fees is prescribed by the college, then those fees or 30,000, whichever is higher. Now you can imagine they're talking about higher. Generally, it is always lower. In income tax, if you see, it will always be lower. Here it is higher. That means if the school fees are 25,000, you can remit $30,000. If the school fees are $40,000, you can remit $40,000. Why? Because our government doesn't want our people to go there and have no money. No, it is not correct. We should have sufficient money to maintain ourselves outside India. That's the reason we are allowing higher amount. Whatever is the fees which is there, we can remit money outside India. Of course, we have to produce. There are conditions. We have to produce the letter for the fees and all that. And if you submit to the bank will allow you to remit. So there is no issue. Hospitalization, medical expenses, any amount you can remit money outside India. So there is no questions asked. Compounding proceedings rules are there. How do you do compounding? When you have to go for a compounding with a folded hands, there are rules. Okay, you have to apply this way. You have to apply in this form. These are the things which you cannot do compounding. All this is given in the rules. Certain things you can do compounding. Certain things you cannot do compounding. How compounding fee is computed, that also is given in the rules. But that is a benchmarking. That is not the law. You cannot hold RBI and say no, you have to please give me compounding fee like that only. No. It is just a method of working it out. RBI can decide whatever they want, and you cannot challenge them. No, see, it is mentioned in the rules. You do that way. No, it is only an indicator. Okay, if this is a violation, this will be the compounding fee. But generally, RBI follows that principle, but they can always deviate. It is their prerogative. And compounding is not your right. Tomorrow, if you apply for compounding, it is quite possible RBI may say, this particular violation will not fall under compounding and you have to go for penalty. So, and then of course, against the penalty, you can appeal. Against compounding, you cannot appeal because you are going voluntarily, you're going with folded hands. Overseas direct investment, there are rules for that. There are non-debt rules. Now, what is non-debt? Equity. Any equity investment coming into India, there are rules. Overseas direct investment is the money going out of India to investment in a company outside India. So, these are the rules over there. Master direction, I have already explained to you. I don't want to waste your time on that. I have already explained you in what is the master directions. It is basically Reserve Bank's training for the AD banks as to how they are going to administer the law. And it is published. It is not a private thing. See, you understand, master direction is not some direct communication from the RBI to the bank. It is published on the website. You can download. Although it is for the bank, but you yourself also can take the benefit of that master direction. You can download it and use it, no harm. Okay, you can tell the bank, look, your master direction says like this. If you are some bank is asking you something which is not there in master direction, you can show them, look, your master direction is telling that why you are asking this document. You can always challenge, because I have seen sometimes the AD banks are not aware about certain law and about the FEMA, and they try to ask something more than what is required. You can always challenge them when you know the law, when you know the master direction. You can tell them, no, this is not required. You see the master direction, and they will have to accept it. I have educated so many AD banks on the FEMA because their team didn't know properly how to implement FEMA. And initially, I'm talking about long years back. Now, of course, the teams are being trained very well, and they, of course, whenever you talk to AD bank, a branch will not know anything about FEMA. They will refer your matters with their team which is in FEMA, a central team which is in FEMA, and whatever documents you will give, it will be emailed to them. They will verify those documents and they will say, okay, now you can remit this transaction. It is not a very long drawn process. It may be 1 or 2 days it takes, and you can do the transactions. Now, what is the FEMA? How the sections have been allotted? Section 2 talks about definitions. Any act will have a definition. You know, income tax also has got section 2, which is definition. So definition comes under section 2. Then we have got section 3 to 9, basic concepts and regulations and management. Then we have got section 2C and 10 to 12, authorized dealer. What are the powers of authorized dealer? Because authorized dealer is a very important person in FEMA. It does everything on behalf of RBI. So, what are the powers, how they will implement, all that is given under this 10 to section 10 to 12 and section 2C. 13 to 15 talks about contravention and penalty, how you are going to deal with it, penalty and other things, what happens. If penalty is levied within 90 days, you are supposed to make the payment or file an appeal. And then prove it to them that yes, you are not required to make this payment or you don't have the means to make the payment. Then it's fine. Otherwise, you are supposed, if you don't do any of this, then you are supposed to make this payment within 90 days. Otherwise, prosecution is initiated. This is the only place where there is a prosecution. In FEMA, there are two places where there is a prosecution. This is one place, and there is another section 37A, where you have got assets which are outside India, which is not substantiated by any remittance from India. For example, you are allowed to remit $250,000 outside India. That means around 2.5 crores or whatever. You have acquired assets much more than what you have remitted. And the ED finds out that you have got assets outside India much more than what you have remitted outside India from the banking channels. That means you have acquired these assets through some other means, Zavala means or whatever means. Then prosecution is initiated. Then there is no penalty. Penalty is also levied plus prosecution. Both are levied. And that assets can be confiscated. All the things can happen. So that is a very serious offense. And that is where the FEMA comes into prosecution, criminal law. Whereas otherwise it is all civil. If you have violated some law somewhere, some transaction, automatic route, you have missed out on some regulation, you have instead of 100 rupees, you have allotted shares at 99 rupees, then that no prosecution, it is penalty. Okay. So that again, you can go for compounding with a folded hand, you can get relief. 16 to 35 talks about adjudication and appeals. Adjudication is for penalty. Penalty is adjudicated, and after that, you can file an appeal. Against compounding, there is no appeal. So 36 to 38 talks about enforcement directorate. What are the powers of enforcement directorate, how they are going to regulate. And 39 to 49 are general provisions. I told you 46, 47, 48, I told you those sections. So these are all general provisions relating to the FEMA law. Some substantive provisions we will look into it. Now see, FEMA law per se is like, starts with this. Okay, you cannot do anything. You can't do anything. You can't remit any money. You cannot transact any money. You cannot do anything. There is only one small rider here. Now read this section. Read this section. Don't read the red part. First read the black part. No person shall. No person shall means it's a mandatory. Deal in or transfer any foreign exchange or foreign security to any person not being an authorized person. That means with other than authorized person, you cannot do any transaction with anybody else. In outside India, you cannot remit money to any foreign company. You cannot get a money from any foreign company, make any payment to or for the credit of any person resident outside India in any manner. So the blanket, it says you can't do it. But now you read this red line. Save as otherwise provided in this act, rules or regulations made under this with the general or special permission of the Reserve Bank. That means what is provided in the rules and regulations, you can do it. Otherwise, you can't do it. So very simple. The law is very simple. You cannot do anything other than what is prescribed in the regulation and rule. So if you import, when I am giving so many lectures, I get a lot of queries. And the queries are something which is our creation of our mind. Can we do this? Can we do this? Please read the regulation. If regulation says you can do it, you cannot, you can do it. Otherwise, don't do it. You cannot. I will give you a simple example. Somebody had asked me a question. Somebody's friend, one person's friend, had some medical emergency. Now, that person did not have money. So the friend who was a resident in India and a friend was outside India, he was having some medical emergency outside India and he needed some money. Now, the friend, on a humanitarian grounds, wanted to remit money to that friend. Well, the regulation says you can't do it. You cannot. Now, it can be that the person's relatives can remit money outside India. Close relatives of a person, what is permitted in regulation is very simple. Close relatives of the person can remit money outside India for medical emergencies, for anything. That is allowed. But a friend cannot do it. Friend is not a close relative. So this is what it is. You cannot do it. So you have to follow the law. Simple. Okay, if you have done it by default, by mistake, go to the RBI, go for compounding with a folded hand. There was a medical emergency. I had no choice. I had to pay $1,000 over there to admit him. All that story you have to tell them. Maybe you will get a very small nominal compounding fee and get away with it. Okay, may happen. So these are all these sections which I am talking about, where it is clearly saying that no, you can't do anything unless it is provided in the rules and regulations. Now, capital account transactions, which alters, very simple. What is capital account transaction? Very simple. If there is a person resident outside India, for him, a capital account transaction is what is changing its assets and liabilities in India. That means he is investing in shares in India, he is buying properties in India, he is giving loans in India. All this is capital account transaction for a person resident outside India. Now, what is a capital account transaction for a person resident in India? Any change in the asset and liability outside India. Sorry. Any change in the assets and liability outside India, because he's a resident in India. So if he is investing outside India, anything, it is a capital account transaction. If he is lending money outside India, if he is buying property outside India, it is a capital account transaction. Very simple logic, simple principles. Now, there is a lacuna in the Act which says includes transactions referred to in subsection 6.3. 6.3 is already deleted, but still the reference is made to section 6.3. Anyway, this is a lacuna. They have to delete this particular line under the section. The capital account transactions, central government with the consultation of Reserve Bank has prescribed the rules how to do the capital account transaction. What are the restrictions? Capital account transactions are restricted under automatic rule and unapproval rule. You can do this subject to this following the condition. If you don't follow the condition, you can't do it. As I told you, money coming into India under the investment in a company, an Indian company is under dealing in TDR, you can't bring the money. It's prohibited list. So you cannot do it. Simple. Even though it is a capital account transaction, but you can't do it. It is under prohibited list. So what are the regulations which person resident India, investment in foreign securities, foreign currency loans raised in India and abroad? These are the capital account transactions. Transfer of immobile property outside India is also a capital account transaction. Guarantees issued in favor of person. Any guarantees issued or pledge, all these things. Because when you are investing outside India in a shares in a company, now that company is borrowing money from some bank and they need a guarantee from the shareholders or the directors. Yes, you can give guarantees. It is allowed. What are the rules? Of course, you have to comply with the rules. Without complying with the rules, you can't do it. Loans and overdrafts, borrowing from person resident outside India, maintenance of foreign currency account. Even the residents can maintain RFC account, resident foreign currency account. Even an exporter can have an EFC account, export earners foreign currency account. So all this is now, if you are a chartered accountant practicing, you can advise your client, why don't you keep an EFC account? I will tell you what is the benefit of EFC account. We will deal with it little later on the deposit, but let me share with you now, since we have raised this topic. EFC account is an export earners foreign currency account. Now, why do you need this account? Suppose an exporter is earning money in dollars. Now, there are two options with him. The money comes into India, immediately he converts into rupees and takes it to his current account and uses the money. Fine, no problem. He can do that. Now, he is also importing materials. He is also spending money on foreign exchange, travel and other things. Now, he gets, let's say, $1,000 on export realization. Now, the next day he wants to, $1,000 he has converted, let's say, 80 rupees in India. So he has got 80,000 rupees in his pocket. Next day, when he wants to remit money outside India for $1,000 for buying some goods from outside India, he will have to pay not 80 rupees, he will pay 82 rupees because the buying and selling rate is different. So 2 rupees he will incur more cost compared to what you 82,000 he will spend. So instead of that, if you had kept this $1,000 in EFC account, he can use this $1,000 again to make the remittance. He will not lose that 2,000 rupees. So that's the difference. That's the benefit. So you can keep this money in EFC account. Of course, within a month you have to utilize it, or you have to bring it to your regular account. You can't keep it forever. Insurance policies you can take outside India. Yes, it is sometimes very lucrative. You can do that. Capital account transactions for person resident outside India. This we saw is for person resident in India. Investment in India. Person resident outside India is making investments in India by way of shares in an Indian company. And that will boost our Indian economy, the growth. Because today, if you see the Indian growth, it is only because lots of huge amount of foreign investment has come into India. And that has helped us in boosting our economy. Investments in India, capital in firm and LLP also can be done. That is also allowed now. Acquisition of property in India can be done by NRI and OCI only. A foreign citizen or a foreign company cannot buy property in India. And very simple. Another thing, non-resident and OCI cannot buy agricultural property in India. It can buy commercial property, residential property. It cannot buy. This is prohibited. So nobody can give you approval. Guarantees in favor of resident in India. Deposits with resident in India. Foreign currency accounts in India. It can open foreign currency in accounts in India. Remittances outside India, and non-resident Indians can open NRE accounts, FCNR accounts. All these accounts it can open in India. Now, key definition. We will look at only one definition as of now because time is short. So we are already on 6:11. We have to complete by 7. There's a lot of things I want to explain you by the end of the session. We will define person resident in income tax. We have got 3 different types of residential status. We have got resident but not ordinary resident, and non-resident. Here in FEMA, there is no concept of resident but not ordinary resident. Either he is a person resident in India or a person resident outside India. And a person resident outside India has got 3 different categories. One is a non-resident Indian, the second is an overseas citizen of India, and third is a pure foreign citizen who have got no links with India, who has been born, brought up, and is a citizen of foreign country itself. So he is not at all connected with India. Now, overseas citizen of India earlier was considered as a person of Indian origin. Now, person of Indian origin has now been changed to OCI. Now, what is the difference? Person of Indian origin did not require any registration or require any card or anything like that. If he was anytime a Indian citizen and has gone to US and has become a US citizen, he is considered as a PIO, irrespective of he has applied anywhere. He doesn't need to apply anywhere. He becomes a PIO in any case. Or his father or grandfather were at any point of time citizens of India, he gets automatically a status of PIO. Overseas citizen of India, same criteria is applicable, but he will have to register on the passport, the Ministry of External Affairs website, which is on which you do the passport registration and on that passport application. You have to register there. You will get an OCI, Overseas Citizen of India card, and then only you are an OCI. Otherwise, you are not an OCI. Even though you might be a person of Indian origin, and if you don't hold this OCI card, you will not get any benefit under the FEMA. Non-resident and OCI more or less are at par in terms of FEMA. They get all the benefits more than the pure citizens of foreign countries. What they don't get benefits, NRIs and OCI gets more benefits. They are allowed to invest in certain securities, certain assets, which a pure foreign citizen cannot do it. They are allowed to buy properties in India. For a pure citizen cannot buy property in India. So there are some privileges given to NRI and OCI. These privileges are not given to pure citizens, all given again in the regulations and rules. Definition of person resident, very simple. If earlier that 182 days rule was not there. Now they have introduced recently 182 days rule. Earlier it was only intention. Now it is number of days plus intention. Both have been combined. In the FEMA, in income tax, we only have number of days, no intention. Where it is in number of days and intention, I will explain you what it is. When a person means resident in India, they have defined person resident in India. So if he's not a person resident in India, he becomes a person resident outside India. So it's a negative definition. So we have to first define what is a person resident in India. Person resident in India means a person who has resided in India for more than 180 182 days during the preceding financial year. We are all staying in India, so we are all residents in India as far as FEMA is concerned. Now, it is quite possible that you might be a resident for FEMA, but you are non-resident for income tax. The other way around also, it is possible. But it will not be same. So you have to find out whether you are, just don't go by the income tax definition. You have to go by what is the FEMA definition as far as the FEMA is concerned. Because the things which you can do as a person resident in India or person resident outside India under FEMA are different compared to income tax. So if he is stayed for more than 182 days outside, in India for in the preceding previous financial year, then he is a resident in India for FEMA purposes. There is an exception to this. Suppose somebody who has stayed for so many years in India, but suddenly in April, he has got a US job and he has got a US visa. Now he is living on 18th of, let's say, April. He is living for abroad. He will be on 18th of April of that year. Even though he has stayed for 182 days in the preceding financial year, he will be considered as a non-resident from 18th of April. And immediately he will have to write to his bank that you please convert my bank account into an NRO account or NRE account. He cannot own ordinary account. Very simple regulation. You cannot own. If you own, you are in trouble. You will have a problem. There was one client who went outside India, didn't know that he is required to inform the bank. After some time, RBI issued a notice. Then he came to us. Oh, this has happened. Okay, now let's go to RBI and go for compounding. Okay, bhai, there is a violation. We went with a folded hands. Okay, bhai, there was an error. There was no malified intentions. And they, of course, condoned the delay at 500 rupees compounding fee. But it is all subjective. It may happen in some cases. It may not happen in some cases. So you have to be very careful and inform the bank immediately when you are going out of India. So whoever goes out of India for taking an employment outside India or for a business, carrying on his business outside India or for an uncertain period. Suppose if his children are staying outside India and he has now decided to shift with his children for a long-term purpose on a long-term visa. Yes, he will be considered as a person resident outside India the day he has traveled outside India. Now, the other way around. The other way around is a little tricky. It is not simple. The person who has come to India for otherwise than of employment, otherwise than for business, or otherwise than for this is considered as a non-resident for the purpose of FEMA. But who are these people? If you have not stayed for 182 days, if you have not stayed for 182 days outside in India in the earlier preceding year, and you have come into India suppose you are working outside India, you are having a job in Dubai or job in USA, and this year you have decided to settle down in India, take up a job in India, and you have come down to India. In last year, you have not stayed for 182 days in India. You will be still a non-resident till the time you don't stay for 182 days in India. So you have to be very careful. This interpretation is very, very tricky. One person got into trouble because of that. What happened is he came to India for leaving his job in Dubai, and he came down to India in April some particular 2012, I believe. He came down to India, and in August 2012 he bought an agricultural property. NRI cannot buy agricultural property. Now he thought he is a resident because he has settled down, he has come down to India, now he has taken an employment in India, so he is now a resident in India. No, he has not stayed for 182 days in the preceding financial year. So he is still a non-resident and he cannot buy an agricultural property. The penalty was levied. He went into appeal and penalty was reduced, but still penalty was maintained. And the law was very clear that you are still a non-resident. You are not a resident. Any person, any body corporate incorporated in India is considered as a resident, even though it's fully 100% shareholding is a non-resident. 100% directors are non-resident, no problem. 100% directors, foreign directors. 100% shareholders, foreign company. Still, that company will be considered as a resident in India if it is incorporated in India. Very simple law. No complications. No management issue where the management, place of management, nothing is to be seen. Company incorporated in India, LLP incorporated in India, whoever is the owner doesn't matter. It is a resident in India. Okay, irrespective of the holding and the ownership or the directors, nothing to be seen. So this is the basic definition of this case study. I already told you a person who goes to outside India, who has lived in UK for 200 days, I think I will skip those cases. Okay, we'll take it up. Suraj, who is a citizen of India, who has lived in UK for 200 days during the financial year 23-24, resides in India for less than 182 days in financial year 23-24, and is a citizen in India, hence is a resident for 24-20. Okay. Mr. Rajesh, who is a citizen of India, left India on November 23 for employment outside India. He will be non-resident once he leaves India, as he has left for employment, and the criteria of 182 days will not apply. I told you very clearly. When he leaves, there is no problem. When he is coming back, 182 days has to be seen. Mr. Harsh, who is a citizen of India, left India on May 23 for business outside India. Yes, he will be a non-resident from the day he leaves. Now, even the students who is going for studies will be considered as a person resident outside India. They are not going for business. They are not going for employment. But they are not going for uncertain period. They are going for certain period because it is already, the curriculum is already decided. In spite of that, there is a circular 45 which says that they will be a non-resident. Why? Why they have been given this status? Because they might take up a job outside India. They might need money outside India. For that, they need to transfer money outside India. So all that benefit has been given to even the students who are going outside India. Under FERA, citizenship was a deciding factor. I think I will go little, I'll skip this because I think I've already explained you this. OCI, I already explained you, so I don't want to waste your time on OCI. OCI, I already explained. Authorized person. Who are the authorized person? There are authorized person is a wider term. There are authorized dealer is a bank. Whereas money changers, even the hotels are allowed to take the foreign exchange. When the guest comes in, he can take the foreign exchange, but he cannot deal in foreign exchange. He has to deposit whatever foreign exchange he received in the bank. Whereas an authorized dealer, that is the banks, can deal in foreign exchange, can give you foreign currency, can receive foreign currency, can do all the foreign currency transactions with you. He can do overseas investments. He can receive money for your investments in India. Do LRS, do 1 million scheme. 1 million scheme is for the NRIs. LRS is for resident. So this we can do it. Suppose a client comes to you, I want to remit money outside India, I am a resident in India. Oh yes, you can say suggest LRS, $250,000 you can remit outside India. Of course, the money under LRS has to be from the own funds. It cannot be out of borrowed funds. If he has taken a loan from somebody and remitting out of India, no. If another thing, gift, if he has received, that person, non-resident Indian, 1 million scheme, he is remitting money outside India. Now, 1 million scheme, it be out of his NRO balances. He cannot receive gift of more than 250,000 from a resident. If he receives 1 million as a gift from from a resident, that person cannot remit 1 million out under the 1 million scheme. He cannot even receive that 1 million as a gift. Maximum gift he can receive is $250,000 for a non-resident from a resident. Now, let's look at a definition of control. We all know a control means more than 50% of the shareholding. But in overseas investment rule, they have made a control definition as 10%. If you are holding 10% or more, you have a control. So why? Because naturally, if you are investing more than 10%, that means unless and until you have a control, you will not put in more than 10%. You will put in 1 or 2%. So they said you have a control once you are having 10% or more in the foreign entity. So there's a difference in the control definition. Net worth, very simple. Now, why this net worth is important? Net worth as per the Companies Act section 257. Simple. You don't have to do many adjustments in the net worth. Whatever is as per your audited accounts, which will be considered as a paid up capital and free reserves, which will include paid up capital and free reserves. Now, net worth shall have the same meaning as per clause 257 of the Companies Act 2013. Now, very simple, I will give you one very interesting case. In Ind AS and AS, the net worth changes. We all know under accounting standard, a redeemable preference share is a part of net worth, part of paid up capital. You are to disclose in the capital because it is a preference capital. So redeemable preference or non-redeemable preferences or convertible preferences, everything goes under the capital. So if you are following the accounting standards, then your net worth will include redeemable preference shares. But if you are following Ind AS, your Ind AS will not contain redeemable preferences. It is considered as a debt. So redeemable preferences is not part of the paid up capital or a net worth when you are looking at Ind AS balance sheet. So whatever is the method you are following, whatever is the platform you are following, you have to go as per the net worth. You cannot. Now, why this net worth is important? Why this net worth is important? Because when you are making overseas investment, there is a restriction. You can invest only up to 4 times your net worth. That means 400% of your net worth. So when you have to calculate your net worth. So net worth is as per the Companies Act, as per the financial audited statements. Now, which financial audited statements? Now, suppose, for example, I will give you an example. It doesn't say annual financial statements. It says audited financial statements. Now, let's say a company is incorporated in April 25 and they want to make an overseas investment in July 25. They don't have a March 25 balance sheet. So how do you calculate the net worth? You can make a interim balance sheet of 31st May or some date, which in between date, or get it audited. Get a balance sheet audited as per the whatever gap you are following, and whatever is the net worth, based on that, you can remit 4 times the money. You don't have to go for the annual audited account. It is not required. You can have an interim audited financial statements, and based on that, and now if you have an audited financial statements, their validity is 18 months. That means, for example, if you have a March 25 audited financial statements, that net worth is valid up to September 26. You can use that net worth up to September 26. You did not make an interim balance sheet for that. And after September 26, naturally, 6 months have passed after the March ending 26. You need to have March 26 audited financial statement even under the Companies Act. So naturally, you will have a March 26 balance sheet in October 26. So then you apply March 26 and you cannot rely on March 25 balance sheet for your 400% net worth. What I will now do is that we'll go into some regulations of deposits. Very interesting. I'm going to explain you the NRO account and NRE account. What is the difference? Non-resident external and non-resident ordinary accounts. Non-resident external account, I will explain you in a different way, not ordinary way, which normally under FEMA. I will explain you in a different way, but you will never forget for life. That is what my assurance is. We all travel outside India, right? When we travel outside India, we clear security. After that, we clear immigration. Now, after clearing immigration, now the immigration officer can ask you question, why you are traveling, whether you have got a proper visa. It will check your visa documents. It will ask you some few questions. And if you're satisfied, and if your name is not on the banned list, you cannot travel, then they will put a stamp of exit, and then you are allowed to travel, allowed to go out. Then after you clear the exit, you are waiting at the gate. Now, when you are waiting at the gate, what is your position? You are technically outside India because your exit stamp is there on the passport that you have exited country. Now, you are waiting at the gate, but physically in India. So, technically outside India, physically in India. NRE accounts are like that, are like waiting at the gate. They are technically outside India, although it is open in India. The accounts are lying with any of the banks in India. You can go to Union Bank, you can go to HDFC Bank, any branch, and open an NRE account. It is located in India, but technically it is outside India. Now, what I mean by technically outside India, any balance in the NRE account can be repatriated freely without any questions. No immigration officer will question you where you want to travel. Now you are at the gate. You can travel anywhere in the world. Nobody is going to question you. So similarly, NRE account is like the person waiting at the gate. Now the money in the NRE account is freely transferable anywhere in the world. Nobody is going to question you. You don't have to do any documentation. Just go to your bank and say, I want to remit to so-and-so branch in London. Fine, the bank will remit to you. No questions asked. No, he will not even ask you for 15 CA, 15 CB. No documentation, nothing. Just it will be immediate transfer because you are freely allowed to go. Now, NRO account. NRO account is before immigration. Is waiting in the queue for immigration. It is not cleared immigration. Now, any money going out of the NRO to outside India requires immigration clearance because it is in India. The account is technically located in India and physically also in India. Both the conditions are in India. technically as well as physically in India. So any money moving out requires immigration clearance. Now, what is immigration clearance according to me? It is 15CA, 15CB first. 15CB is basically a document which the auditor, chartered accountant is supposed to certify that whether the tax on this has been deducted or not. So this is the first thing we have to see, whether the money going out of India is tax paid. NRE account, you don't have to see. NRE money is going out, no tax payment because it is a freely convertible, freely repatriable money. NRO account, yes, any money going out of India requires this 15CB because it requires to see that tax has been paid because it's a local money. The account is in India. It has to still clear immigration. Immigration is nothing but 15CA, 15CB plus whether this money is repatriable. That question is coming from the various regulations. If the regulation says yes, you can repatriate, yes, the money is allowed to be repatriated. Like on that exit stamp, we will ask you question whether you have visa. So that is a visa. That money can be repatriated outside India. And of course, it will see whether tax has been paid, 15CB. So both these conditions are satisfied, the money will be allowed to be remitted. So if you want to transfer from NRO to NRE account, again the same procedure. It has to clear immigration. It has to give the both these conditions to be satisfied, whether repatriable and whether the tax has been paid. Because once the money goes to NRE account, nobody is going to question. So if the question is asked at this NRO level. Money deposited in NRO account, no questions asked because it is local. It is all local money. If you want to issue checks in local currency, local payments to in NRO, no issues. NRE also local payments coming inside, no issues, no immigration. Only going outside is the immigration. Any money coming from outside India to NRE account and going outside India, no questions asked because like transit, it is a transit. You are outside immigration. You have cleared immigration. You are sitting at the gate. You can come from India to Singapore, and from Singapore you can board another flight to Auckland. Nobody is going to ask you. No immigration clearance because you are not entering Singapore. So it is NRE account is like that. Any money coming into the from foreign to the NRE account and going out of NRE account, no questions asked. Indian government has got no control over that. So no immigrations, no 15CA, no 15CB. You can do that. So this is how the NRO and NRE account is to be looked at. So this is how I explain you in a very simple language. Now you apply this concept anywhere, you will never go wrong. Now any money transfers from NRO outside India, yes, you will have to comply with immigration because you are in India. NRE account, any money going into NRE account from India will require immigration clearance naturally. Now see, for example, I told you current account like current account transactions like rent, interest, dividend, all this is repatriable. So if there is an Indian company who is declaring dividend, an Indian tenant who is paying you the rent, Indian bank who is paying you the interest, and they want to directly credit to NRE account, yes, it can do it. But immigration has to be cleared. 15CB, 15CA, all has to be complied with. And then only the money can go into NRE because NRE is sitting at the gate and the money is in India. So when money is going from India to that gate, it has to clear immigration because immigration comes in between. Without that, you cannot transfer it to NRE account. Once it goes to NRE account, then no questions. Then the money can go out of India. So this is the difference. These are different accounts can be opened, foreign currency, non-resident account. In this NRE and NRO accounts are in Indian rupees, whereas foreign currency balances are in the dollars or the foreign currency, whichever foreign currency you want to use. Non-resident external accounts, the interest income is exempt under Income Tax Act. NRO account, the interest income is taxable in India. This is as per Income Tax Act. NRO account, any balance in NRO account, 1 million scheme is applicable. You can remit, still repatriate outside India under 1 million scheme. Now, from where this 1 million scheme is coming? There is a regulation, there is a circular, there is a notification, remittance of assets. I told you, remittance of assets, and a 1 million scheme comes under that. So again, there are rules on what basis 1 million scheme has to be implemented. How do you implement? What are the sources and what sources are general. There is no, even if somebody is not repatriable otherwise under a regulation, okay, you can still repatriate under a 1 million scheme. I'll give you an example. Money coming in from outside India into an LLP by NRI under a non-repatriable scheme. Under a non-repatriable scheme, there are repatriable and non-repatriable scheme. It comes under a non-repatriable scheme to an LLP. Now, when he is exiting, the money he is getting his capital out. That money will be credited to his NRO account. Now, suppose if he gets 12 crores from that capital withdrawal, 9 crores, which is 1 million, he can repatriate immediately under 1 million scheme. 3 crores, he can do it next year because every year he gets 1 million. So next year, but suppose if it was a repatriable amount, if that investment was under repatriable, entire 12 crore could have gone out. That will not go under 1 million, but that will go under that scheme, which is repatriable scheme. So there is a difference. Now you understand what I mean. If your investment is on a repatriable basis, you don't have to go under 1 million scheme. So you can repatriate the entire sale proceeds out of India. If you are under a non-repatriable scheme, the money has come under non-repatriable scheme, then the money which comes into your NRO account, the money will be in cash and transferred to your NRO account, and that NRO account 1 million scheme will be applicable, and not the, even though the money initially was non-repatriable, it becomes repatriable under 1 million scheme. So maximum is 9 crore you can transfer. This I have already explained. Current account transactions I have already explained you. There are prohibited items under current account. Schedule is there. Schedule of prohibited like lottery, gambling. You cannot remit for that. For any of those items, like, if you do online gaming, you cannot do any remittances for that. You cannot buy lottery with your money from transfer outside India. Then there is a restricted list with the permissions. There is a restricted list with limits. All this is given as in the current account transaction rules. Schedule 1, prohibited items. You cannot do this, irrespective of the limit or whatever quantum. Schedule 2, restricted list with permissions. You can do it. Restricted list with limits. Like, for example, if you want to say pay consultancy fees to any consultant outside India, maximum you can remit is $1 lakh. You cannot remit $2 lakh. So these are the restriction with limits. You have to look at these schedules and see what are the limits. Then there is gift. I told you, gift from resident to non-resident cannot exceed 250,000 USD. This is part of the current account rules. Medical expense as per estimate from the hospital, whatever the hospital is estimating, it can be $1 million, it can be $2 million. Yes, we can remit outside India. There is no limit. Your education expense, I told you, whatever is the estimate by the university, or $30,000 per academic year. Remittance of asset, I already explained you, 1 million scheme and 250,000 for resident. Again, for both 1 million as well as 250,000, you will require 15 CB. And as a chartered accountant, it is an opportunity for us to certify this 15 CB. Without our certificate, money cannot be remitted outside India, whether it is $250,000 for a resident or $1 million for a non-resident. It cannot be remitted without your support. This is already I explained you. I don't want to waste it. 250,000 that gift I told you, and that remittances also I've explained you. Now I will explain you in short, because time is a little short. We have got another about 30-40 minutes to go. I will explain you two major important provisions of the foreign exchange rules and regulations, and one is the non-debt rules, and there is the overseas investment. These are the two, incoming and outgoing. How you are going to implement the regulations. There are what is the non-debt rules. Now non-debt rules have got chapters. They've got around 10 chapters, and they've got about 9 schedules. Now, acquisition of property in India is one of the chapter, one of the schedule in this non-debt rules. It was earlier a separate regulation. Now they have merged with non-debt rules. I told you, only NRI and PIO is word used now. It is OCI. Ignore PIO. It is OCI. Allowed to acquire property in India. A pure foreign citizen not allowed to buy property outside India. Person resident outside India is a very wide term. It includes NRIs, it includes OCI, it includes pure citizens, it includes pure foreign companies. Pure citizens of foreign citizens, pure foreign companies cannot acquire immobile property in India. Only NRI and OCI are allowed to buy immobile property in India. And NRI, OCI also, there is a restriction. They cannot buy agricultural property or farmhouse in India. They cannot buy. They can only get inheritance. Now I will tell you one very interesting case happened. There was a person situated outside India. Father was in India, resident in India. His son went to US and took up a job. He was a US person resident outside India. He was working in US. Now he sent out a gift to this father. The father, without stipulating for what you want to use, he didn't say. He sent us a gift and it's allowed in the FEMA. There is no restriction, no amount restriction. He can give as much gift as he wants. The other way around, there is a restriction. Resident cannot give non-resident more than $250,000. But from non-resident to resident, there is no restriction. It can come $1 million, $2 million, $100 million. There is no restriction. So he sent out some gift to his father, resident father. Now, a resident father, applying his own mind, used that money because now it is belonging to him. He bought an agricultural property. After buying the agricultural property, he died. After some time, he died. Now he is the only son. So that inheritance, by way of inheritance, this property went to that son. All this transaction was reported to RBI, and RBI issued a notice that you have done all this as a matter of conduit. You have acquired this property, agricultural property, indirectly. You were not allowed to buy agricultural property, but you have done this in a circuitous manner. There was a representation saying that first transaction, giving a gift, allowed under that. RBI said yes, no problem. It was permissible. The resident father buying an agricultural property, allowed under FEMA. There was no restriction because the resident can buy as whatever they want to buy. There is no restriction. Yes, allowed. Father dying. How can you say it is a conduit? It was not a planned thing. Death is not planned. This is a natural phenomena, and it happened. It was never planned. The son never told him that you buy this from this gift, you buy agricultural property. No, he never said anything. You don't have any evidence on record. RBI accepted this thing and condoned the entire thing. The matter was dropped. The penalty proceedings were dropped. So there is, he can only inherit the property, agricultural property. He cannot. Suppose if he was a resident, at that time, if he had bought an agricultural property and now he becomes a non-resident, he's not supposed to sell. Please, he can continue to own it. Similarly, a non-resident staying outside India, he has bought some properties outside India. He has bought some assets outside India. He has bought some shares outside India. Now he comes down to India. He is not required to sell everything and bring it to India. No, he can still continue to own it because he acquired when he was a person resident outside India. So he's allowed to continue to hold it. Okay. So this is the law. FEMA is very, very liberal. It doesn't say that once you come to India, you sell everything and bring it to India. No. Similarly, when he is going out of India and he is owning residential property, no problem. He can continue to hold. Even though now he's become person resident to India, he cannot acquire new property after he becomes a non-resident. That is the rule. NRI can gift any property to resident. NRI can sell. NRI can sell agricultural property to only resident. He cannot sell. Suppose, for example, he's got inheritance. Now he wants to sell. He cannot sell to NRI OCI because NRI OCI cannot acquire. So who can he sell? Only to the resident. Now there is another rule that when you have got properties in India, when you have got some properties in India and you have residential properties in India and you sell residential properties, more than 2 residential properties, if you sell, then you can only remit up to 2 residential properties outside India, repatriate. You can't repatriate 3rd residential property sale proceeds outside India. So that is the law. Now this is the entire scale of what are the foreign non-debt rules. The various schedules which I was talking about, foreign direct investment, foreign portfolio investment, foreign investment by NRI or OCI on repatriation. I told you, there are certain schemes which is repatriation, certain schemes which are non-repatriation basis, investment by other than non-resident. Now I'll explain you in a very short and a nutshell how you have to apply this non-debt rule. Foreign direct investment, what are we supposed to do? Suppose there is a foreign company there is an Indian company. Now Indian company wants to get a capital from outside India, wants to raise capital outside India, from outside India. Fine, it can do it under this foreign direct investment rule, under automatic rule. Now, what are the conditions? Number one, first it has to see which business it is occupying. If it is the business, there is a sectoral caps. There is given under this rules only. What are the sectoral caps? Each business is defined, and some businesses got 100%, some business got 49%, some business got 74%, and some businesses are not even listed in those entities. Now, If it is not listed, this entity, this business is not listed in your entity, in this particular thing, it is 100% allowed. So no need to worry. Now, in some cases, if it is listed as 100% also, there can be some conditions. You have to see these conditions, and those conditions have to be complied with. Now it could be 49%. So you cannot bring 50%. You can only bring up to 49% foreign investment. The remaining 51% has to be Indian owned. So this is how the sectoral caps we have to see first. Then you have to get a valuation done. I told you, if the valuation discounted cash flow method is 100 rupees, you cannot allot shares at 99.99. You can allot at 100, 105, 110. Now section 56 to 7B is not applicable. So you don't worry about it. Foreign money coming in at higher premium, no issues, no tax in India. So the money can come in at a higher premium, no issues. Okay, but it cannot come at a lower premium. That is secondly. Money has to come from the inward remittance. It cannot be from local source, not allowed. NRO is not allowed. The money has to come either from foreign inward remittance or NRE account, because NRE account technically is money outside India. I told you this. So from NRE account, he can bring the money. It is as good as money coming from outside India. And the foreign remittance from outside India is allowed. Now you need a KYC from the bank over there. The KYC will tell you whether this particular person is okay or not okay. The money comes in, no questions asked. The money will come into your bank account, get the KYC, and write in that the remittance advice that it is for acquisition of shares. Don't put any vague things like business, working capital. Don't do all that. Acquisition of shares, very clear. The purpose has to be mentioned. Okay. So the acquisition of shares is mentioned. Now the money has come in. Within 60 days, you are required to allot the shares. No reporting till date. Everything is on automatic. You have to do it on your own. It's self-governing. It's a self-governing thing. So you allot shares within 60 days as per this particular principles, the sectoral caps, the valuation norms, all these things you take into account and allot the shares. Once the shares are allotted, within 30 days, file form FCGPR with the Reserve Bank of India. Reserve Bank of India will see all these documents which you are attaching, and they will verify if everything is in order. They will not say approval letter. It is not an approval because you don't need approval. It is a simple letter taking on record this FCGPR. And this taking on record letter is very important, because when you want to exit, when this investor wants to exit and remit money outside India, this letter is very important. Without that, he cannot repatriate outside India. This is where we make a mistake. As a chartered accountant, we must ensure that this email has come and or letter is taken on record, and that is preserved for future exits. Otherwise, you will have a problem later on. Foreign portfolio investment is investment in shares in the stock market. That again, there are certain limits and percentages. If you go into detail, it is a one-day topic. It cannot be explained in a few hours. For foreign portfolio investors, a foreign portfolio investor is allowed to invest in, who is registered with the SEBI, is allowed to invest in the stock markets. Then there is the non-resident Indians on the repatriation basis. They can invest in the shares of an Indian company, or they can invest in the shares of the stock market also. There is, of course, the limits are there. You cannot exceed. If it is more than 10%, then it goes under FDI. If it is less than 10%, it comes under FPI. Investment by NRI, OCI on a non-repatrial basis. See, I told you, sectoral caps, all these norms are applicable only for foreign direct investment. If you are on a repatriable basis, foreign direct investment is a fully repatriable. And that foreign companies, foreign citizens are also allowed. NRIs, OCI is also allowed. But in separate benefit given to NRIs and OCI on a non-repatriable basis, even though sectoral cap is 49%, but NRI, OCI can invest 100% if on a non-repatriable basis. Now that sectoral caps is not applicable. Okay, they cannot invest only on the prohibited sectors. They can invest on any company. No valuation, nothing, pricing guideline, nothing is applicable. Very simple, but it is non-repatriable. The money, when they exit, money will be credited to NRO account and not to NRE. They cannot take it out. Of course, 1 million scheme still applies. Then there are other investment in LLP. LLP also, there are two methods, repatriable and non-repatriable. Repatriable, all the entities outside India, a foreign company, foreign citizens can become partners in Indian LLP. Whereas in case of a non-repatriable, only NRI and OCI can come in. There are certain conditions for both. we cannot, we don't have that much time to go into those conditions. You can go into those N1 tools. You will get all those conditions over there. This is of course I have already explained, so I don't want to waste your time. What are the prohibited sectors? I have already told you: lottery, gambling, trading in transferable development rights, manufacture of cigars, needy companies, real estate business. Now, real estate business does not include construction of houses projects. If there's a development project, it's allowed. But if it is buying and selling of land, not allowed. Okay. So if the company is engaged in just trading in land, not allowed. But if it is doing a project, development project, allowed. Okay, of course, there are certain conditions. You have to follow those conditions. There are two automatics. I already told you, automatic and now which types of instruments they can invest in when they are coming into the Indian company. There are only three types of instruments they can invest in. One is the equity shares. One is a compulsorily convertible, no optional, no redeemable. No, there is redeemable is debt. Optional also not allowed. Compulsorily convertible preference shares. Compulsorily convertible debentures. Debentures we consider as debt, but when it is a compulsorily convertible debenture, it comes as it partakes a character of equity, and that's the reason it is allowed. Compulsorily convertible debentures also allowed. Valuation norms I already told you. FDI time limit I've also told you, 30 days. FCTPR has to be filed, 60 days you have to allot the shares. FCTRS is 60 days. Now, what is FCTRS? Once your investment is made, after a few years, when you want to exit, the transfer takes place between the non-resident to the resident. Resident is buying the shares of a non-resident. That time, one FCTRS has to be filed. Suppose if non-resident is selling to non-resident, no FCTRS is required to be filed. But if a non-resident is selling to a resident, yes, FCTRS is required to be filed within 60 days from the date of the transfer. These are the different forms. Now we will go quickly into DTA and a tax. It's very interesting. Let me just spend some few minutes on that. You know, when I have handled so many of these foreign inward remittances, foreign inward direct investment schemes, money has come mainly from a Mauritius route. There were 10,000 to 20,000 crores rupees of investments we have handled. And most of the big funds, big companies coming into big US companies, UK companies, all having a company in Mauritius, and that company is investing in India. I was wondering why Mauritius, and all the address is one building, one street. You're wondering how come all these big companies have got all the offices in one building only in Mauritius, Portliu. I visited Portliu on a holiday, and I personally went to that particular building and the street, and I took photographs, and I found out that this building contains lawyers. Now, what does this company do? Suppose there's a company based in US, it will ask the lawyer to set up a company in Mauritius. The lawyers only will manage their account. The lawyers only will do all become the directors in the company. After that, the money will come into that Mauritius account, and the next day the money will come into India from that Mauritian company. And why? Because the DTA with Mauritius at that time was very favorable. Like, see, when you want to exit, there is a capital gains in India, and when you are selling the shares of the Indian company, the Section 9 says in income tax that the tax is accruing in India. Naturally, you have to pay the tax in India. The DTA between Mauritius and India was earlier saying no tax in India, the tax is in Mauritius, and Mauritius there is no capital gains. So they were getting away with crores and crores of rupees. I have signed 15 CB of 200 crores, no tax, without tax. And the money has been remitted outside India freely. There is no problem. Now, this was agitated, and PIL was filed with the Supreme Court. Azadi Bachao Andolan case was filed, and the Supreme Court directed the government, you amend this law, amend this DTA. They amended this DTA from, I think, 2017 onwards. There's amendment saying that no, now the tax will happen in India also. But it is prospective. It is not retrospective. So now, why? Again, when I checked with Finance Ministry, I said, why do you allow this? Why are you foregoing the tax? I said, we are not concerned with the tax. Tax is a small cost, but we are getting so much of money because of this route that our economy is boosted because of that. We are getting 10 times economy multiplier. So we don't mind sharing out some amount of tax. We can forego some tax. This was a principal policy which the government had followed. But then it was been, because of this PIL, it was amended. Overseas investment. 5 minutes I will complete overseas investment. Suppose there is a company in India. Now they want to buy us, want to invest in the foreign. Now it is other way around. It's other way around. They want to buy shares of the foreign company. They want to do business outside India. For that, they want to set up a only on subsidiary outside India, or acquire shares of some company outside India. Now, how do you go about it? Very simple. The Indian company has a balance sheet, asset. Even any LLPs also can invest. A firm can invest. Individuals can invest under LRS scheme. Individuals cannot invest under ODI pure scheme. ODI pure scheme, of course, you have to combine LRS and ODI. Whereas a foreign Indian company or Indian LLP or Indian firm don't have to comply with LRS. They have to comply only with ODI. Whereas an individual will have to comply with LRS as well as ODI. The limit of for individual is not 400%. It is only $250,000 LRS limit. Whereas for a company, firm, partnership firm, or that the limit is 4 times their net worth. Now, firm के लिए net worth क्या होगा? Capital balance. Whatever is the capital balance, 4 times they can invest outside India. Now, what you have to do is first find out what is your capital, what is the net worth. As per, I told you, as per the latest audited financial statement, it doesn't say annual audited financial. I explained you that. And that is audited financial statements are valid for 18 months. You can use that for 18 months. Now, you have got, let's say, 1 crore rupees of your net worth. You can invest up to 4 crores outside India. Now, 4 crore will include all the investments put together. Suppose you have invested already 2 crores earlier. So now the maximum you can invest is 2 crore more. You cannot, every transaction is not 4 crore. The total transaction that you have done is 4 crores. Now, that what is the overseas investment? What you can do? You can do, first you will have to become a shareholder. First, when you have to buy at least 1 share. Then you can transfer money by way of loan. In case of foreign direct investment in India, there was no loan concept, only shares. Whereas in outside India, you can first buy shares. First, you have to buy shares of that company. Even 1 share you have to buy, but you become shareholder. And then the remaining amount, suppose you want to invest 4 crore rupees outside India, at least 10 lakh rupees you buy shares, then 3 crore 90 you can buy remit by way of loan. You can even remit, you can even give a guarantee, but all this will be within that 400% net 400% limit. You cannot give more guarantee than the 4 times the net worth. Then it becomes a non-automatic route. Go to RBI to get approval. So this is what it is. Very simple. It is very clearly saying 4 times the net. Of course, there are other conditions also. That suppose if you are an NPA, you have defaulted in your bank loan, you need an NOC from the bank. Naturally, one hand you are defaulting on your bank loan, and the other hand you want to remit, you want to invest outside India, not allowed. You have to get NOC from the bank. Bank should say, okay, we don't mind. If you are investigated by ED or CBI, you need an NOC from them also before you can invest. So all this condition, again, now what valuation? See, when the money is coming in, the valuation was different. When the money is going out, the valuation is totally different. Common sense. When the money is coming in, you cannot allot the shares at a price lower than the value. In case of when you are remitting money outside India, it has to be at the fair value. It cannot be at a price higher than the fair value. Simple. When the money cannot go out more than what is the value. Simple logic, common sense. This is like that. So you have to get a valuation done of that company, foreign company, and do this, and you can allot shares up to their valuation, whatever valuation is done. Then there is a one form FC is to be filed before you remit. Now see, when the money came in for an investment, you didn't have to do anything when the money has come in. Money has come in, allotted shares, then you file FCGPR. In case of money remitting outside India, first file Form FC with the bank. Now, Form FC will contain one Schedule E. Schedule E is the statutory auditor's certificate certifying that all the compliance has been done as per this 400% limit. All this NOCs, everything is done. The valuation, pricing. There is one more thing which you have to look into it when you are remitting money outside India for buying the share. FATF. Now, what is FATF? It is Financial Action Task Force. Now, this is the body which is located outside India. It is not the RBI. It's a worldwide body. they monitor all the jurisdiction, all the countries. And if they find some countries are not having any laws relating to money laundering, then they put them under the grey list. Now, if that country is under grey list, you cannot remit money to that country. You cannot buy shares of that country. So this is FATF we have to see. And as a statutory auditor, when you are certifying, you must see this FATF. Download FATF on the day when you are certifying. Don't download prior few days before, because this list keeps on changing. And if you have verified few days back and then you are certified after a few days, and if the list has changed, this country has come into the grey list, you are in big trouble. On the day on which you are certifying, check that list. That is very important for statutory auditor. That is the principle you should follow as an auditor. Then once you follow all this, the money goes outside India, fine. Everything is, you can remit hundreds of crores subject to your net worth. If your net worth is permitting, yes, you can remit money outside India. If you have got money in EFC account, this limit of 400% is not applicable. You can remit money from the EFC account. So that is a benefit that is given to export owners. These are some case studies which I have already explained during the course of this. Liberalized remittance scheme, I already explained you. Yeah, this you have to file one FLA, form FLA for any company which has got foreign investment in India or foreign investment outside India. Will have to file in 15th of July one return called for foreign liabilities and asset return, FLA, giving the details about their investments outside India and in India and all their financials. It is given in the FLA form very clearly. Simple information is required to be submitted online with the RBI. Export of goods and services, I have already explained a little bit during the discussion. Compounding and penalties, I have already discussed. Penalties is 3 times. Compounding also I have explained. Delay in reporting. Now what they have done is, earlier it was compounding was for any delay. Even if the FCGPR instead of 30 days, you file on 35 days, there was a compounding earlier. Now they have come out with a late submission fees, like how in income tax we have got a late submission fee. If you file a return late, you have to pay some fee. Same way in MCA, if you file the return late, you have to pay some fee. Similarly, they have come out with the LSF for any document which has got no transaction value, transaction reporting. Like for example, is FLA or APR. This is not transaction, it is annual reporting. This annual reporting, if you delay, then 7,500 no per year factory. If for in any year you have not delayed it, how many years was it? Maximum 3 years. 7,500 you have to pay and finish it. Whereas if there is a FCGPR, which has got a transaction reporting, FCGPR is a transaction reporting. Foreign investment has come, foreign FC form is a transaction reporting. If something is missed out there, then there is a formula, 7,500 plus 0.025% of the amount involved into number of years which you have defaulted, and you have to pay that LSF, and then it can get regularized. You don't have to go for compounding. In conclusion, FEMA has liberalized the transactions in foreign exchange considerably. As a professional, we have been entrusted with a responsibility to ensure compliance with FEMA before certification, as our certificate is based on which the AD gives approval. Follow the auditing standards. Yes, when you are certifying, follow auditing standards, documentation before certifying. With this authority comes a great responsibility on our shoulders. With this, I complete my session today. If there are any questions, Mansi
yes, sir. We have few questions. Can I read out one by one, sir?
Better read out because I can't see them on the slide.
Okay.
I will answer those.
Sir, if a income earned by NRI via investment done with the money from NRO account or a money from outside India, what will be the taxability in India, and whether that income can be transferred outside India?
Yeah, very simple, very good question. Any income accruing in India for whether he is a resident or non-resident, entire income will be taxable in India first. So you will have to pay the tax, and the remittance can happen outside India are net of tax. And in when the section 195 applies, 195 when it applies, the tax has to be calculated totality as per DTA. Of course, if the DTA gives a lower rate, you apply that lower rate because it is beneficial, section 90. But when the DTA does not prescribe anything, then it is at the highest, whatever the rate applicable to that particular transaction.
Okay. Yes, sir. Thank you. Next question is, One of our client has got a green card of USA recently and he intends to stay in USA hereafter. Does he need to convert his saving bank account in India into NRO account immediately on leaving India, or can he wait for 182 days stay outside India on completion of which he becomes non-resident?
He has acquired a green card, but that means he has got intention to stay for longer. There are three conditions he has to. Any of the three conditions he can comply. One is he has taken up a job outside India. He may not have taken up a job, but he's got a green card. Fine, it is possible. He might have started a business outside India. He may not have started a business outside India. Okay, still fine. Third, his intention to stay outside India for uncertain period. Now, when he's taken a green card, he's got a long-term visa. That means he can stay for an indefinite period outside India. Definitely, that intention is there for staying out of India. He becomes a non-resident on the day he travels outside India. And the day he has traveled, he has to intimate all his ordinary accounts, convert into NRO or NRD, whichever he wants.
Okay, thank you, sir. The next question is, can I transfer funds as a gift to my son who is OCI cardholder in Australia as a gift? If so, what is the limit?
I told you 2,50,000. A resident, $2,50,000. When the resident can gift to a non-resident close member, it cannot be to any friend or anybody. Then the section 56 and all applies. You know, income tax also is going to tax you. So 2,50,000 to a close relative. Yes, dollars I'm talking about.
Okay. What is the upper limit to spend outside India by an individual during personal or official foreign trip?
There is no such cap. 2,50,000 is a max LRS.
LRS applies. Right.
There is no internal cap for travel. Okay. You can spend whatever you want because now it is liberalized. I know, I remember I used to travel during FERA times. $500 they used to give me as FTS. Only maximum you can travel. You cannot spend anything more than that. That also a lot of approvals and all that. But now there is no limit.
The next question is, can agriculture land be purchased via NRE or NRO fund of NRI, but agreement executed by resident person?
It cannot be done. Sorry, you cannot use your money. This is exactly what happened in that case. He had bought the property in the wife's name, but he used his NRO funds, assuming that he has become a resident. No, you cannot do that.
Okay. Yeah, this was already covered in your case study.
He paid that money to his wife or his relatives. He can do that, and the resident could have bought, like how in that case the father bought the agricultural property. That is allowed.
Okay. The next question is, FFMC license is applied online or physical submission need to be done at RBI regional office?
No, I'm sorry, I didn't get the first.
FFMC license can be applied online or
no, I am not aware about this license.
Okay.
I'm not aware.
We shift to next question. Can an individual be a non-resident for RBI purpose but a resident of India?
Yes, exactly. That is what I said. You can be. I'll give you a simple example. Suppose somebody leaves India in January. Let's say 26 years left India for USA, taking up a job. Now, from that day he has left, he has become a non-resident person. But he has stayed in India for more than 182 days during the financial year. So income tax will say he's a resident.
Resident in India, yeah.
So he will be resident for Indian purposes, income tax purposes, but he will be non-resident for now very important. See, this is very interesting question somebody has asked. But I will share something more into it. When he becomes a resident in India for income tax purposes, you know there is a law which says that you are required to disclose all your foreign assets. A person, resident but not ordinary resident or a non-resident is not required to disclose. Now in income tax, he is a resident. FEMA is a non-resident, so you would have opened a bank account outside India, you would have acquired some assets outside India. All this will be required to be disclosed in his March 26 return. Because he's a resident of income tax in March 26. This is very important. People forget. He says, oh, he's a non-resident, so not required. No, for income tax, he's still a resident. So don't miss out this.
And sir, income tax department has become quite strict in this declaration process since
Yes.
last year.
Yes, there is a 10 lakh
Lots of
rupees of
people got
penalty.
notices for foreign asset declaration last
Exactly.
year.
There is a separate sale, foreign asset investigation unit.
And so what is the punishment of
10 lakh rupees per year. And if there is an income which you have not disclosed, then there is a prosecution.
Okay.
10 lakh rupees per year.
It's lot.
Not a small amount.
No escape from this.
No escape from this.
Oh my God. Okay. So thank you so much, sorry, for the insightful session. It was really, really very knowledgeable session for me, and I believe that for all the attendees. Thank you so much, sir.
Madam, can I ask you one small question now?
Sure.
How many people attended? I could not see what were the number of participants.
I think for that I need the help of committee.
No issues, no problem.
Even I don't know, sir.
No problem, no problem.
But
Just wanted to, as a curiosity, I wanted to know how many people have taken advantage of
we
this.
will let you know, sir, through message.
Yes, I will be
Definitely.
really grateful to you if you can let me.
Thank you. I think I have met you, sir, in Bhopal.
Yeah, I was there in Bhopal. Yes, I gave the similar
Yes,
lecture.
I've met you there. Thank you so much, sir. Thank you.
Thank you, everybody, for having a patient hearing. And I hope I have made your FEMA little easy.
Definitely, you have made it. Yes, I am speaking on behalf of everyone today. Thank you, sir. Good night.
Thank you very much, sir.